Hello, welcome back, guys. So, Amazon just announced earnings. The earnings actually came out like a couple of minutes ago, and you will see that they are down 17%, almost 18% over here in the after hours market, sitting at about $91. Very interesting here. It's getting super interesting for Amazon. It's a company that I do not own and I would love to. So, let's take a look at what happened. Now, the earnings again are super fresh, like you'll see they're updated one a minute ago. Amazon sinks on weak fourth quarter guidance here. They reported earnings after the bell. They did 28 cents per share and revenue of 127 versus 127.4 according to the estimate. So they did a little bit less here. Now, obviously, they had a rocky year, pretty much as all of the big tech, which is down tremendously. Macroeconomic headwinds, soaring inflation, of course, and rising interest rates that the government has caused. All these challenges have coincided with a slowdown in the overall businesses pretty much, and the consumer spending, of course, as you can understand. It's probably going to get a little bit worse in the upcoming year too, I would think. Now, let's see here what we're having from Amazon. They have responded to rising expenses by aggressively cutting costs, it looks like. So we're expecting much less expenditures like operating expenses here from Amazon. It did said actually warehouse space, which is unfathomable for a company like Amazon, which kept buying warehouses pretty much. They halted some experimental projects. Of course, they see what is happening with Meta, and so they are not willing to take part in such a happening at this current market because companies get punished for potentially investing right now, and also freezing hiring for corporate roles and things of that sort. So the thing is, revenue growth is projected to come in at 15%, marking a return to double-digit expansion, which is great for a company like Amazon, which is obviously super huge and still growing at double digits. It's absolutely insane when you are making so much money already. So the business is looking great overall, and again, going down almost 20% now. It's probably an amazing, or at least it gets there to being a very nice opportunity for a buyer, for a long-term buyer, that is. Now, of course, in this current market, things can go down even more. We'll see whether that's going to be the case, but it's actually very promising. It's looking super promising here. What is happening with Amazon? Now, this article gets updated by the minutes as more news come out from Amazon because they're still having their earnings report. And you will see here that Amazon said it expects to post fourth quarter revenue between 140 billion and 148 billion, representing growth of 2% to 8%, while they were expecting a much more lucrative 155.15 billion. So this is a pretty significant difference, and is one of the core reasons why the stock is down quite significantly right now, sitting at 17%. Let me actually refresh just to see what's happening right now, because the tool is obviously, it's actually even more right now. So yeah, it's actually down almost 19% over here. So yeah, the tool gets updated pretty much real time. Okay. So let's take a look, because right now this is getting super interesting. Again, we're sitting at $90 for Amazon. So what I'm going to do is obviously first take a quick pass, because we do know that Amazon's numbers are amazing here. 177 billion to 470 over here. Absolutely tremendous growth, and this company being sold out of 20% of its stake. Are you crazy? I mean, okay, but yeah, so that's what happens in these kinds of markets. Now, 3 billion to 33 billion. Although I have to say that Amazon was expensive to begin with, so it may make sense for people to sell over here. But especially if you have been holding for a while, and of course, you got to see what kind of numbers, what kind of ratios, and what kind of cash the company is generating, which we will examine. But we do know that this used to be expensive. Now, after this drop today, we'll see. We'll see about that. It may begin to look more and more interesting. And it's something. It is a company that definitely deserves being in a watch list right now for sure, because it also could go down even more. Now, in terms of the balance sheet over here, you will see that they are having total liabilities of 282 billion and total equity of 138.2. And I could see them buying back shares right now, especially after they're going down. We'll see what is going to be happening with their buybacks, whether they will be announcing some extra buybacks here. Because, yeah, right now, they haven't been buying back, but right now, as the company stock price is falling, well, this may get interesting. And we do know that their free cash flow is probably going higher at least, just because they have announced that they will be cutting down on capital expenditures, it looks like, so less warehouses and things of that sort. And you will see here that 46 billion was the operating cash flow, and we came down to free cash flow of minus 14, just because the company was spending a lot in capex, in capital expenditures here, more and more. Obviously, a company that is cash hungry in terms of capital expenditures, they keep expanding, and it makes a ton of sense. But right now, as we're in a decline, this is why we're looking at them pretty much, not having any cash flow just because they were spending it. It makes sense. But right now, again, as investors and the whole stock market is actually crashing because of the current environment, because of the current economic climate. You are looking at these companies not really wanting to take a risk because they don't want their investors to get burnt. And, this is obviously the most important thing for a company, for a public company. And yeah, since they don't want this to happen, they cut down on these expenses. So we do expect that their free cash flow will go back to normalcy, or at least closer to that. And in terms of their investing activities, they have been always pretty much purchasing maturity investments here, as you'll see, and also selling some, but for the most part, they have been a net buyer, as you'll see over here. And in terms of financing activities over here, you will see that they actually got a little bit of extra debt over here. But again, this is a company that is making tons, billions of money. So, debt is not a big thing. It's not an issue. Now, if we go back to our metrics page, this is right now showing a P ratio of 100. So this is an expensive company, and the price to free cash flow won't be very relevant because, again, remember the company was spending tons in capex. We do know that, so this is not something that we can actually take a very, very, study. Actually, take a look at it, because it doesn't make sense based on what the company is doing. And of course, the same thing is going to be with the total liabilities free cash flow. So I wouldn't pay attention to these numbers for Amazon just because we know that they have been spending a ton. Now, the thing is, 199, this is going to go down about 20%, it looks like. So we're going to be sitting at about like a 60 maybe, 60 something of that sort. So it still looks expensive. We'll see about that. And so there may be room for, for going down even more. And I actually, frankly, never thought I would get to a buy price for Amazon. So we'll see, because I don't really remember what kind of price I was getting for Amazon as a buy. But we're going to take a look at our tool next, which will tell us what kind of price to expect, what kind of price we'd want to buy the company for. And remember, when we're buying for a long-term investment, we don't really care about what is happening today. We do care about what is going to happen in the next 5 to 10 years, for example, or even more. So this is why our projections here are for 5 years. And so the revenue growth we did see here, remember, when the article was actually in its previous form over here, that the company was expected to keep growing at double digits over here. Now I'm still going to go with lesser revenue growth here, so I'm going to go much more conservative. Let's just say that Amazon grows 8, 10, and 12% over here for the upcoming years, which I think is very possible for a company of this sort, but I'm not going to go with the 28, 26, or 21% that they have been doing, which is obviously tremendous. Net income margins, now the margins for this company are low, something to be expected, although they were higher, with the years, as the years were progressing, because obviously, you get much more efficient with how you are actually spending and how much you are actually making as the years pass. And it's economies of scale. And so we're going to go with net income margins that are about that level. So let's go with 5 may be too low, 6 and 7 though, because 5.5 was a 3-year average. Actually, the 5-year average has been 4.5. So maybe they go back down to that for a while at least. Now, in terms of the free cash flow margins, this is something that we can use the previous years for, just because the last year was obviously a lot of capex, but also the previous years were a lot of capex. So the company has been spending a ton. And other than that, they have been making tremendous cash flow margins pretty much. And so I'm going to go with something that is relatively normal, and it may be a little bit more for a company that is making a lot of free cash flow. So I'm going to go with 100, 110, and 115, let's just go. And annual return of 13% over here. And let's see what we get out of these values. Now, you will see that the current price is not 111, remember. The current price is near 90. So with 90, we're sitting at a 82 high, 61, 62 medium, and 43 low here, with projections that are likely to happen, frankly, very likely to happen. And so what I would want it to be for me to purchase Amazon right now is probably somewhere around the $70 range, maybe even 60 if it gets there. But again, I would be willing to pay a little bit more for a company of this sort. Now, it's not as much as I would be willing to pay for Apple, for example. I would be willing to pay a little bit more for Apple over Amazon. So frankly, I may even want it to be at 60, because Amazon is not a company that has like super high margins. It's not a company that is at that software level business which is making tons of money and has high markups. It's a company that is selling hardware, and so their margins are not that great. However, they're pretty much the king of their space, and so it's gonna be difficult for anyone, frankly, to compete with them at that. And so over the years, I think they're gonna be doing tremendously well, and this is why I would be willing to pay a little bit more if I get the chance. So frankly, if it goes somewhere around $70, it may be the time for me to take the plunge. So thank you for watching the video. Do tell me what you think about Amazon, whether you own it or not. What are you thinking? What's your price, frankly? I'd love to hear it, because I myself, I'm actually stumbled by what is happening in the markets right now. I mean, lots of companies, especially the tech ones, getting destroyed. And so, getting them at a cheap price and then, waiting for like 10 years, these companies can easily like tenfold, like very easily. A company like Amazon could definitely be at $1,000 in 10 years from now, very easily. And so, yeah, I'm getting more and more interested, and I'll talk to you in the next few videos if we get some more news about these companies. So stay tuned, and I'll see you soon. Bye bye.